Welcome to Podkey Slopcast, where exploding AI revenue meets some very real market stress. A lot of the AI story right now comes down to one question. Are we looking at durable demand or just leverage and narrative getting ahead of reality? This week gives us both sides at once, with enormous reported ARR at the labs and some ugly reminders of what happens when crowded trades meet margin calls. The headline numbers are eye-popping. OpenAI reportedly put up July ARR that exceeded its entire second quarter, putting annualized recurring revenue just under $50 billion. Anthropic's alleged jump is even wilder, from a $47 billion run rate in May to $71 billion in July, with some people extrapolating to $100 to $150 billion by year-end. The first thing to separate here is confirmed fact from inference. These are run rate style numbers, not audited full-year revenue, and run rates can make a very fast-growing business look more settled than it is. Still, even allowing for hype, the direction matters. If customers are actually consuming enough inference and API volume to support those levels, then this is not a niche software market anymore. What supports the bullish case is that these companies are not selling a fixed number of software seats. They are increasingly selling computation and output, which means usage can compound much faster than a normal enterprise SaaS model. What complicates it is margin, concentration, and durability. Revenue can surge because a few giant customers are pulling forward demand, because credits and subsidies are smoothing adoption, or because pricing still sits above long-run competitive levels. That gets to the core framing here. AI demand is being measured in total tokens consumed, not in named user licenses. If that framing holds, the market is basically a total addressable market for tokens. Every useful completion, every agent step, every generated artifact adds to revenue somewhere, even if the model is cheap or specialized. That logic is strong as far as top-line demand goes. A lower-priced model does not necessarily shrink the market if lower prices unlock much more usage. But it does shift where power sits. If tokens become abundant and cheap, then the winners may be the firms with the best distribution, the best integration into workflows, or the cheapest infrastructure, not just the smartest frontier model. So the token thesis supports continued growth, but it does not automatically prove persistent pricing power for any one lab. The bullish physical argument is straightforward. Demand for machine intelligence is rising faster than the world can build data centers, power capacity, and advanced chips. If that is true, a supply-demand gap should persist for years. In plain English, people want more intelligence than the infrastructure can deliver, so whatever capacity comes online gets soaked up. There is real logic there. New use cases keep appearing, and cheaper inference often creates more demand instead of less, which is a classic elasticity story. The missing context is that supply is not static and demand is not frictionless. Models get more efficient, routing improves, hardware utilization rises, and some workloads turn out to be less valuable than the early demos suggested. So the cleanest claim is not that demand will overwhelm supply forever. It is that for now, the evidence points to demand growth staying very strong relative to build-out, with the exact duration still uncertain. OpenAI cutting the smaller GPT 5.6 model prices fits this bigger picture. Luna reportedly drops 80% to 20 cents per million tokens, Terra falls 20% to $2, and there is also a faster mode. That looks less like distress and more like strategic shoring up. If the market is usage-based, then lowering price on smaller models can defend share, expand adoption, and funnel customers deeper into your stack. The trade-off is obvious. Lower prices can pressure margins and train customers to expect rapid deflation. But if demand is supply-constrained overall, the bigger risk may actually be losing volume and developer loyalty to a competitor while you protect a price umbrella that will not hold anyway. A separate issue is whether recent market weakness says something fundamental about AI itself. The case presented here is mostly no. The Nasdaq being flat to slightly down year to date, and semis drawing down 23% since June, lines up more with macro fear, possible Fed tightening, geopolitics, and general risk-off rotation than with a collapse in AI demand. That argument is better supported than the idea that AI fundamentals suddenly broke. Revenue signals from the labs point the other way. At the same time, stocks can fall even if fundamentals are intact, especially when expectations got very far ahead of cash flows or when levered investors have to sell whatever is liquid. That brings us to leverage, and there are two different kinds in this story. One is infrastructure leverage. Analysts estimate hyperscalers have about $1.65 trillion of data center debt parked in special-purpose vehicles rather than sitting plainly on corporate balance sheets. The scary comparison is 2008, but the structure matters. If this paper is held by private credit firms and pension funds rather than chopped up through opaque bank-centered CDO chains, systemic contagion is less likely than the headline suggests. Less likely does not mean harmless. Off-balance sheet financing can still obscure who ultimately bears the risk. And if AI economics disappoint, someone is left owning expensive, long-lived assets financed on assumptions that looked safer during the boom. The second kind is market leverage, and here the examples are much more immediate. In South Korea, the KOSP reportedly fell 40% in a month, with about 1.2 million leveraged retail accounts caught in the downdraft and roughly 360,000 liquidated. That does not tell us AI is broken. It tells us leverage can turn a correction into a cascade, regardless of whether the original story was sound. Same with the Situational Awareness Fund. Implosion Leopold Dash reportedly built 30 billion of equity into 120 billion of AI-linked exposure through 4 times leverage, then got hit by drawdowns and margin calls. Citadel buying the distressed book at a 20 to 50% discount makes this look much more like Archegos than like LTCM or Bear Stearns. Painful, concentrated, and destabilizing for holders, but not automatically a system-wide event. The main lesson is that price action can reflect forced selling rather than a sober reassessment of long-term AI cash flows. One quieter but important data point comes from KPMG's analysis of 1.4 million workplace AI interactions. Their finding is that the highest impact users do not just write clever prompts. They treat the model as a reasoning partner, framing the problem, iterating, checking, and refining. That matters because it changes the adoption story from pure model capability to human workflow capability. If effective collaboration patterns are teachable at scale, then enterprise value creation is not only about having access to the best model. It is also about training organizations to ask better questions, verify outputs, and redesign work around the tool. That is a slower and less glamorous bottleneck than GPU supply, but it may matter just as much for who captures the value. So the clean read is, AI demand still looks very strong, but the market wrapped around it is full of leverage, financing tricks, and valuation assumptions that deserve real scrutiny. That's it for Podkey Slopcast. This episode was generated by Podkey. Create your own at podkey.fm.